Greetings, everyone, and welcome to another edition of Clearing the Air on Agricultural Policy. This is a podcast monthly presentation of the Barry Flinchbaugh Center for Ag and Food Policy, and it's presented as a companion to the podcast known as Smoke and Mirrors, Ag Policy Unfiltered. That's out of Kansas State University. I'm your moderator for this conversation, Eric Atkinson from K-State, and we'd point out that the Flinchbaugh Center's aims fit nicely with what we're doing today to improve understanding of policy alternatives and consequences, to enable informed decisions by policymakers, by agricultural leaders, food system stakeholders, and the public at large, and to ensure that agricultural policies and strategies are based on facts and on rational consideration. So with that in mind, it's our pleasure this time around to bring into the discussion two individuals who are actively engaged in agricultural policy research and development at a high level. We'll tell you more about them shortly. First, I'd like to introduce our panel this time around, and Jenny Ifft is with us. She'll be leading the conversation in just a moment. Jenny, professor and extension specialist and the Flinchbaugh Agricultural Policy Chair at Kansas State University, also the host of that podcast, Smoke and Mirrors, Ag Policy Unfiltered. Also with us, Professor Emeritus and longtime agriculture and rural policy specialist out of Iowa State University, Mark Edelman. Welcome to the both of you. But let's tell you a bit about our guests now. They are from the Agriculture Risk Policy Center at North Dakota State University. Sandro Steinbach is with us. Sandro is an associate professor in the Department of Agribusiness and Applied Economics at NDSU, and he directs the Center for Agricultural Policy and Trade Studies, as well as the Agriculture Risk Policy Center at NDSU. Sandro teaches undergraduate and graduate classes on agricultural policy and trade, risk management, and applied data analysis, and his research focuses on, of course, agricultural policy, risk management, as well as trade. And his work has appeared in top field and general interest journals through and through. So we'll bring Sandro in just a second after we introduce his colleague, Shawn Arita. Shawn's the Associate Director of the ARPC at NDSU, and before joining the center, Shawn served as a senior economist at the USDA's Office of the Chief Economist, where he led key analyses for USDA farm programs. He was recognized as the USDA's Economist of the Year for his work on market disruptions on U.S. agriculture. Shawn also previously served with the U.S. Trade Representative's Office in the Agricultural Affairs Branch, and prior to that was a research economist at the USDA's Economic Research Service. So great expertise to tap into today. We'll turn it over to them and to Jenny to lead the discussion. Jenny?
Okay. All right. Sandro, Shawn, thank you so much for joining us. First of all, Sandro, I think congratulations is due. You're just a professor now, right?
Yeah, just a professor now.
That's what I said
Not
about
promoted.
myself. Is that official now? Is it July 1st?
Yeah, it's
Okay.
official since April, but I have to update the system somewhere, right? It's with the fiscal year, it's officially on the paycheck, but otherwise it's official since I think May or April when they had a ceremony at NDSU.
That's
Thanks.
awesome.
Appreciate it.
As you want to start us off, just explaining what is the Agricultural Risk Policy Center, ARPC?
Sure, happy to do that. The Agriculture Risk Policy Center is one of three federal policy research centers that directly work with USDA, Congress, and agriculture stakeholders on ag policy issues broadly defined. ARPC is very much complementary to the other policy research centers, which focus on outlook and representative farm modeling. Our focus areas primarily in the area of Title I and Title XI programs. So meaning we are the center that works on crop insurance issues actually, and more broadly also looks into trade and market disruption issues.
Okay, great. So we talked to Seth Myers of FAPRI last month, and he explained how a lot of the work that FAPRI does is directed by Congress. So how much of ARPC's work, as it currently stands, is sort of being driven by requests from policymakers or Congress, and how much of it is more public-facing?
Yes, that's a really good question. I mean, all of the policy research centers work quite a bit with decision makers in DC, being it from the private sector, the public sector, as well as Congress. So there's triad of different requests that are constantly coming into the center, being it related to how the farm safety net should be updated, how changes to the farm bill programs are going to impact producers, and how those decisions can be shaped to benefit agriculture producers, more specifically farmers and ranchers in this regard. So our requests are coming from all of those different entities, and they're largely driven by the question: how can we use economic data? How can we use economic data to help make informed decision making actually? And we as a center, we operate pretty much non-partisan, right? We are not a center on the left or the right. We are a center that works with all different constituents actually. As requests come in, as needs are coming in, we provide information, and then decision makers can use this information to inform the decisions that they have to make at a national level or at a state level.
Right, right. Now, ARPC is maybe 2 years old now, 3 years old?
Yeah, 2.5 now. It's
Two and a
time is
half.
running.
Okay. Okay. So what's your vision for ARPC down the road? Like what do you see ARPC's identity being, and after a few more years when things are, they say, fully established with lots of
Yep,
experience?
we are super excited where we have gotten with ARPC over the last 2.5 years. Actually, I mean, got a good team together of really qualified, really expert economists actually that can speak directly to the needs as they come from DC actually. So we feel pretty proud actually on where we have gotten over the last 2.5 years, and we see ourselves as a center that is driven very much by the impacts that we generate actually. So for us, the work that we do is only as useful as the impacts that we can help make with this work actually. So that means if we work with decision makers in DC, right, we want to make sure that the work that is implemented actually or that is conducted at the center, which is tend to be pretty data heavy, it tend to be pretty economics driven actually, that this work actually it helps inform decision making. And that's how we see our vision over the next couple of years is building this impact, building and growing this impact to benefit US agriculture.
That's great. Could you walk us through an example of a specific project? And I want to hear not just the research or the content, but what the process looked like.
Sure, we were thinking about a good example that can be made public at this moment, actually. And there had been a project that Dr. Arita or Shawn can talk a bit more about. We had been working quite a bit on sugar recently, while there had been a lot of discussion around sugar. But Shawn, please take it from here.
Sure. So this is a good example of some of the way that we provide input. We had a few months ago, Senator Holman's office had requested us to do a study on sugar TRQs. And so sugar is the sector where over the past few years, there has been very much a surge of imports at what they call the high tier tariff. So there's a long history behind this. I won't go through all the details, but to put it succinctly, we've had this over quota tariff set at the WTO over 25 years ago, and that hasn't changed. And so the problem is that, of course, with inflation, we've had very much a protective value of that tariff. And again, keep in mind that the sugar sector faces a lot of global competition in recent years, particularly from Brazil, in part because many of these other partners, they do have some degree of subsidies too. That does also challenge very, very much our own domestic sector, which already has been facing quite challenging times alongside with the other row crops in our overall ag sector more broadly. But the tier 2 imports have been very, very problematic. And in fact, it does in many ways, threaten the long-term viability of the sector in general. It's a very complicated question, but in short, our team did put together an economic analysis of this. So one of the key issues was really demonstrating to policymakers how significant the economic consequences of these new imports were into our market. And so we put together this study. We were able to quantify it through an economic model. We use a partial equilibrium model, and we're able to put this monetary value along the levels of $0.9 to $1.5 billion. This was also cited by a bipartisan letter of over 100 members of Congress. That's caused to highlight a call to action, I would think, in terms of putting this in front of the U.S. Trade Representative, which is currently thinking through Section 301 tariffs. That may be a course of protective measure for the sugar sector, which is, again, very much struggling. There's been a lot of tariffs, and we can talk more about that too. But at this point, there is kind of an active movement in trying to find a resolution for a very, very complicated, I would say, trade policy issue.
The 2026 Flinchbaugh Forum is coming up September the 3rd and the 4th in Manhattan, Kansas. In response to positive feedback from our inaugural forum last year, 2026 features a new format, 2 days of straight-talk conversations on the policies, markets, and decisions shaping the future of food and agriculture. You'll hear from national leaders, industry experts, and the people driving real change across the ag economy. Registration is open now and filling up fast. Register by July the 6th and receive 20% off of your registration. Save your seat at www.flinchbaughcenter.com. The Flinchbaugh Forum, practical policy, bold ideas, and the conversations that move agriculture forward. Let's bring our panel in now to discuss it further. That would be Mark, in addition to Jenny. And let's get right at, obviously, what is a high-profile situation with trade concerns regarding what's happening in the Iran-U.S. conflict and the Strait of Hormuz and traffic through that body of water. What, and this is a 30,000-foot view, but what, Sandro and Shawn, are the two of you keying in on as you watch this unfold and decipher what's going on?
Yeah, that's a really good question, right? There's a lot of news. There's a lot of changing news every day. There's a truce every 4 days that is re-announced, or a new truce coming up. I hope we are now in an agreement that is going to stabilize things, actually, and the strait is going to be open again. We had been working overtime quite a bit on input costs, obviously. There are different mechanisms where in world markets, prices are formed on the world markets. That means actually that whatever we experience in regional disruptions, as they're happening in the Middle East, they're feeding back into global markets, actually. So we had been over time looking quite a bit into what are the implications, right, for farm input cost in America? What are potential outlooks? So we had been running actually simulation models to get an idea on different scenarios on how an opening of the strait, immediate opening, a delayed opening, how would that affect actually input cost? And as you know, many producers had made decisions on what fertilizer to use or to purchase already last fall. So the immediate impact of the war itself didn't hit the bottom line as much in 2026 as it would potentially down the line in the next cycle, actually. So one of the things that we have been spending quite a bit of time on is trying to understand how different opening scenarios could impact actually prices, and looking at where we are right now and the back and forth. Actually, we see concern actually that fertilizer prices for DAP and MAP and others are going to remain pretty much elevated for a longer time than initially hoped for, actually.
Shawn, you have considerable expertise, we're told, in the fertilizer issue as far as trade goes. What's your take on this, and what may portend for the future other than just, well, we're going to have high fertilizer prices? I guess the question is there a hope for some relief for producers in the mechanisms of trade?
Yeah, I mean, like how Sandro had mentioned, there's been a lot of, it's been quite a roller coaster ride on this front. We ourselves have done a set of projections. One thing that we're looking at now is, we're about 3.5 months in, right, following the closure of the Strait of Hormuz at the end of February. It is interesting to look at how the market has responded to this major disruption. And I would characterize this disruption to be much more of a severe supply side crunch than what we saw in 2022, where we actually did see record fertilizer prices. However, this time around in 2026, we didn't see the same level of record prices that we saw back then. And some of it was anticipated. I mean, the fact that crop prices are a lot weaker. That has put sort of a dampener in the terms of what we've seen the fertilizer prices rise. But there was also an interesting pullback on the urea side in particular, because that was the one that everybody was most concerned about, right? We have out of the Strait of Hormuz, it's about 30 some percent of their urea comes out of that strait. But it does seem like the market was perhaps a little bit more resilient than we also had anticipated. There was more supply coming out, and we also had transshipment going through Oman and other areas. There was fertilizer coming out, yet other aspects in there. China, again, is one of the key suppliers. They're a swing supplier. They stepped back into the market on the urea side. That helped a lot. We did see prices pull back significantly, and they are in fact lower than what it was when the strait closed. I mean, before the strait closed, I mean, the urea prices have fallen. On the flip side, though, like Sandro had mentioned, is the other products, MAP and DAP. Those are very, very much elevated. You have other issues there. Sulfur is a key feedstock for MAP and DAP. Almost 40 to 50% of the world's sulfur was also locked away in the strait. So that is continuing to put upward pressure on the MAP and DAP side. And we also have to keep in mind, before the Strait of Hormuz, supply conditions were already tight for MAP, DAP, as well as the nitrogen fertilizer conditions as well. So it just served to amplify that effect. Now, I think the whole issue is, though, is moving to 2027. What is going to be like? And we have seen a pullback on the urea side. At the same time, there is a tremendous amount of uncertainty. We don't know how long this renormalization process is going to take. We have seen that the vessel traffic has had a noticeable uptick over the past week, but nowhere near the levels that it was before the strait. That's going to take time for it to unwind. And additionally, there is this level of uncertainty surrounding the extent of damage of fertilizer-related production infrastructure in the region, in Iran, in Qatar. We don't know the extent that damage is going to take to repair and get their levels of supply production normalized. And that could take months. It could take potentially multiple years. We don't know. And so that could keep upward pressure moving forward well into 2027 and beyond in terms of overall prices. But anyways, so we've seen prices pull back, but they could easily start rising up. We're in this period too where we have gotten past through our big season of bringing in imports, but now we're moving into Brazil and India, which is the top two importers of fertilizers. They start ramping up their levels of imports. Hopefully we'll see that the strait, this deal will carry forward and that vessel traffic will come out, but anything can happen. And so, the best we can do is just, be prepared for uncertainty.
Yeah, I would like to take a step back here. And of course, you all have done a study on, I believe, on impacts of the tariff policies that have been imposed this last year. I mean, for much of the last 80 years since World War II, we were, as a global community, the U.S. was leading an effort to reduce trade and tariff barriers through the 8 rounds of GATT and the establishment of the World Trade Organization, which now exists, but also we've had the development of bilateral trade agreements and so forth. And then last year with the current administration, on April 1st, we moved towards a new direction in tariffs and trade policy. And I think to provide sort of a larger context, can you tell us what impact has the tariffs and reaction to the tariffs by other nations had on our global trading system?
Sure, that's a really good question. We conducted a study 2 months ago through the NDSU Trade Monitor, actually, which is one of our premier outlets actually in terms of communicating trade-related market research actually at NDSU. And that study looked at the impact of Chinese retaliation for U.S. agriculture. So we run an econometric assessment actually to look into how Chinese tariffs that had been imposed in response to U.S. tariffs actually impacted the agriculture sector. And we had one statistical model that is pretty sophisticated, but easy to communicate, actually. You control for everything else that is ongoing, basically. And you look then into what is the impact on trade patterns itself, actually. So our exercise primarily looked into the direct impact on the US-China relationship, and we ignored things outside the box, right? Let's talk first about what we have seen on the direct relationship. Obviously, if there are high tariffs going in place, right, it becomes more costly to export products to foreign markets. And therefore, there's a diversion away from US products. And that was pretty strong. We found that this disruption was almost equal to $15 billion of losses into the Chinese market annualized, which is about 40% larger than the 2018-19 disruption that we had been seeing with the first round of Chinese retaliation to US tariffs, actually. That said, also there's obviously, like, if markets are shifting, right, there's diversion, and diversion means that exporters export products to other countries as well. So we have seen in certain markets significant diversion. Think about corn, right? Where a lot more corn is actually going to Mexico and down to South America than there had been before to other Southeast Asian economies, actually. So while directly we see pretty large disruptions in trade, which obviously harmful to producers because they depress prices, right? There's also a substantial amount of trade diversion that had been observable, actually, in the trade data. That said, right, there's also a high concentration in terms of economic impacts. If you think about obviously those states that export a lot of product to China, they saw quite significant disruptions. Iowa is a good example, right? North Dakota, all the I states are good examples of pretty strong direct trade losses from disruption of this trade with China, basically. Well, some of that had been made up in terms of being able to get to other foreign markets. There's still a likely high net loss that had been experienced by producers, and that puts pressure on domestic prices.
The 2026 Flinchbaugh Forum is September the 3rd and the 4th in Manhattan, Kansas. Join us for 2 days of networking, insights, debates, and more. Register now at flinchbaughcenter.com.
So nobody should feel sorry for economists, but if you were going to, what was say the current trade situation, there's so many different tariffs for different countries and they keep changing. It's not my main area. I can't keep track of the different, they get canceled, but then they get replaced by something new. And okay, you could look at what happened in the past, but how do you project moving forward? How have you all handled that?
Yes, really good question, actually. Right, the best economists are those that can learn from the past. I think that's how we approach economics in particular, is thinking about what experience had been taking place in the past and learn from those. In our recent trade monitor, and Dr. Arita, Shawn had been a major driver behind us. We actually looked into the phase one agreement and how that compares potentially to the framework agreements that we had been seeing right now. And Shawn, please feel free to fill in a bit more on what we find here.
Yeah, so this has been, I mean, as economists, we do have fun with this stuff too, unfortunately speaking. It's not a good thing to say out loud, but you see all these tariffs bubbling up everywhere. Just like you said, Jenny, they've been coming on, they've been coming off. At the same time, it's not just retaliatory tariffs, but it's also what we've been seeing on the import side too, that have also raised costs for fertilizers, seed, machineries, and a whole range of key agricultural inputs. But to your question about how are we supposed to make use of this information in a forward-looking mindset? I think to Sandro's point, the best we can do is look backwards. What have we seen from history? And so for this one, there has been a lot of, there's been a lot of interesting questions surrounding the new set of commitments or pledges that have been reported for China, right? We sort of moved into this new phase of the Chinese negotiations where we've had these tariffs for well over a year. There was the President Trump and Xi meeting in May in Beijing. Part of that was China reportedly mentioning that they're going to buy up to $17 billion of non-soybean products, including reaffirming the 25 million metric ton commitment for soybeans too over the next few years. And for there, what are we supposed to make of this? What does this mean for U.S. agriculture? Will China live up to commitments? What we did do, Sandro, myself, and Gian, and as well as Brent Gale, we looked at the phase one agreement. This wasn't the first time we've had, I would describe, it's a rather unconventional arrangement, right? Where you have these targets being put into place. Back in 2020, there was a similar arrangement where there was targets along the levels of $80 billion for 2 years. At that time, I think many of us thought that that was very, very high. But in fact, they did approach about 80% of that level. And we did have, in fact, almost record levels in 2021. And in fact, record levels of 2022 of U.S. ag exports to China. Now, there's many reasons for that. So part of it is we also got China to remove a lot of its tariffs that are currently still in place right now. And then also too, there was market access reforms for non-tariff barriers in particular. And that really opened up the market. So the question now is whether that could not only be replicated, but at the same time, whether it can have a sustaining deal that has durability. Because what we did see in the previous phase one period, record levels of exports, but in subsequent years, they did fall back down. And part of that was just due to losing eye on the ball, so to speak, after there was priority to get these markets open, and then moving on subsequent years, they sort of lack interest. And it requires a lot of bandwidth to get these markets to maintain being open. China has to clear the deck, so to speak, to let our products in. We will have to see this time around. There's going to be a new commodity board of trade, which will be interesting as well. But nobody knows for sure. We have these targets. China is not like many of our other trading partners where you sign a deal, everybody plays by the rules. Sometimes you do have to put a level of added pressure. Sometimes you do need targets. Let's see what happens, for this go around.
I was going to ask, you mentioned you look back at previous experiences, and I was interested in ag history back to the Smoot-Hawley Act, in which when we raised tariffs up to 60%, I think, in some cases, on about 20,000 goods. Is what we're accomplishing, how is it similar and different from what was done back in and what our experience was back 80 years ago?
Well, that's a good question. I mean, the global economy is not comparable, right? It's 1930s, 1920s period. It's fairly different what we do, what we export, how we operate in global markets. So there are some similarities to be learned about tariff barriers and how they play out, but there are also very large difference. Particularly, Shawn spoke a lot about these non-tariff measures actually, where technical and sanitary barriers actually, which can be even more dramatic than tariffs actually in terms of the impact. I mean, corn is a good example. Beef is a really good example actually in terms of China market access, for instance. So what we can learn in the past that large tariff episodes that are at long last, they can be fairly disruptive actually for the economy actually and can lead to overall welfare losses that can be long lasting actually and have major implications for local economies actually. And that's kind of the message out of the earlier tariff episodes actually, which really depress global economic growth. So it's not just about U.S. implication, but also how the global economy is evolving. Obviously, we as exporters depend on foreign markets. If everyone is doing well globally, people get richer, right? They're consuming more goods actually. And this classical mantra of economic growth leads to more demand for agriculture commodities. That's something I think we shouldn't leave out of the picture actually. If other countries are doing well, they want to consume more pork. And where's that pork coming from? From Iowa, hopefully, also come from China. So in that regard, I think it's really important to take the second component of trade into account is how we contribute to global wealth and growth, and that causes more demand. At the end, everything that we produce is not driven by what we assume we should produce, but what the consumer actually wants. That's both the domestic consumer as well as the foreign consumer. And that applies not just to the end user, but also to the entire biofuel sector, etc. There needs to be a market for things.
So what you're kind of saying, you're kind of providing a response to also why it's not wise, perhaps, that we become sort of isolationists when there is global markets that exist, because that's kind of like, I mean, that's really doing damage to ourselves if we become too much of following an isolationist type policy.
There's a cost and there are benefits to isolation, right? There's U.S. economy is largely self-dependent. I mean, you can do a lot of things in America actually. Our share of trade in GDP is rather small. If you go to countries like Switzerland or Norway, right, the export share is significantly larger than what we see, or Ireland is another example, significantly larger than the US actually. So in physical goods, right, when it comes to capital goods and other things and services, that's a different story actually. But that said, right, every political or society decision, there are always costs and benefits involved. While it may benefit certain groups of having closed borders and limit access to the US market or the other way around, it might create unintended consequences, which can be large and that can be harmful actually. In particular, if we think about US agriculture and its needs for market, right? We need market to sell our products, basically, being it domestically, being it foreign. If there are no substitutes in the domestic market available, no increased large demand or in North America or in South America, the product has to go somewhere. And if no one buys the product, right, there's pretty simply there's no future in that specific business actually. So and I think these fundamental factors should be always taken into account when we make dramatic decisions or when we discuss dramatic policy shifts, actually. There are always winners and losers, and making sure that the losers are taken care of in a transition, I think, is really important. That applies to both opening markets and closing markets, actually. I mean, the transition period, right, of opening up to China, actually, and the losses in manufacturing, which had been associated by economic research and with the China shock, basically. And then AI and robotic shocks. There have been many factors that are ongoing at the same time, but all of those things are actually compounding very much. And I think we shouldn't lose sight of those that are actually are on the losing end and make sure that we provide opportunities for them to actually develop new markets and develop new opportunities actually, instead of just leaving them where they are and struggling.
What areas do you see as we rely pretty heavily on China as a market as we move into the future? How do you see the trading blocks around the world changing and shifting?
Yeah, that is a concern. So, I think if we take a step back and we look at the Trump administration's overall strategy behind this, right? I think, to your earlier question, Mark, like how smooth hauling now, where we have to ramp up the tariffs, and what we've had over the past 12 to 18 months is a different situation in the sense where, this administration, they are looking for more of a balanced trade. They are very, very much focused on trade deficits. Now, economists can seem to generally disagree with just looking at trade deficits, but from their standpoint, if you look at it from tariffs, the U.S. has had very, very low tariffs relative to any of our trading partners. So part of what had undergone under IEEPA and now currently in 122 tariffs, it reset our tariffs very, very much higher. And part of that strategy is because it creates leverage in terms of negotiation. Reciprocity is a key part of tariff negotiations. In order for us to get you guys to remove your barriers, what are we going to give in return? That's the first question, right? In terms of trade negotiations, right? You have quid pro quo, transaction. And so that had been part of the strategy. I mean, there's a more broader strategy with the Trump administration in terms of restoring, in particular, the manufacturing sector that had left the ag sector to some degree more of collateral damage in the sense where now we got hit by some of our other trading partners like China. So now the question though is, we have a very aggressive trade policy. And interestingly enough, only China and to a smaller degree Canada had actually retaliated against our ag sector this time around, a lot less than what happened in the 2018 and 19 trade war. And so there's some interesting dynamics too, and why Europe and some of the other partners in Asia, why they didn't also put retaliatory tariffs on us yet. But I won't get into some of the reasons why that's the case, but then thinking through, we have higher tariffs now. We're using that as leverage. So other countries, and there has been other deals being made by our administration, not only with China, but also ongoing with throughout Asia, getting them to lower their tariffs, Southeast Asia, many other countries, non-tariff barriers too are on the table as well. But if we go too aggressively, there is that risk that other partners are going to look elsewhere outside the U.S. market. Canada looking outside North America. We have other deals that we weren't already a part of, TPP and others. And all these countries, if they do not see U.S. as being a very, very stable or partner that they can easily negotiate with, then they're going to negotiate amongst themselves. And on a global level, this is all good to have more trade agreements. But if you do have a situation which a lot of countries are signing these pacts outside with the U.S. not being a part of it, then the U.S. does get left behind. It faces what economists call higher multilateral resistance with the rest of the world, which means that all these other partners have lower barriers amongst themselves. The relative difference between these levels of barriers, if they're all lower amongst themselves, this actually means we face a relatively higher level of trade costs more broadly. So there is that concern. Again, there's a lot of trade deals going on. We will see how this strategy plays forward. Whenever you're very aggressive, there's risk, right? That's just how it works.
Shawn pointed out an important fact, right? Having one trading partner, it's easier to deal with because you have only one set of rules. If you have a lot of the different trading partners to make sure that all of the rules and regulations are aligned, it's more costly and it requires more engagement. And that's maybe also a good thing to a certain degree, right? We now from economic theory that a more diversified trade portfolio tends to be more healthy because it's more resilient to shock actually. So if you depend on one trading partner only for much of what you export, it's an opportunity because it's lower cost generally in terms of transaction, but it's also in the mid to longer run actually a concern because right it comes at a cost. China has a new African swine fever outbreak. How does it impact certain exports and needs in the country basically? So those disruptions are then multiplying across borders and are impacting the U.S. economy actually.
Well, I want to get in one crop insurance question. It wouldn't be right if we didn't do that before the end. So I am curious what kind of concerns you're hearing from decision makers. I know from my perspective, after the One Big Beautiful Bill Act, OB3, key stakeholders are pretty happy. I mean, there's still a lot of work to do, but if producers, farmers and ranchers, lenders, the insurance industry, they're all, the changes we're seeing as pretty beneficial. So I'm curious what kind of requests you're getting.
Yeah, that's a good question. I mean, OB3 did a lot of good things actually for U.S. agriculture, being in Title I and Title 11 programs, and loan programs. So quite a bit of positive signs actually that came. And I think that also needs to be highlighted a lot more actually, that these benefits are really substantial actually, and they're hopefully going to last for a bit and bringing the cost and a revenue side closer together again for U.S. producers more broadly. On the crop insurance research side, right, what we do as a center, we develop and implement predictive models actually. So it's really important for us to be able to inform not just what happens now and what happened in the past and what are the implications actually of policy changes, but rather be able to model what happens if change levers in the farm safety net actually. And that's what we have been spending quite a bit of work and time on actually is building integrations, data integrations, and process integration with RMA in particular, to be able to build a predictive model that basically scales up from the farm level into the macroeconomic, and how changes to the farm safety net, particularly on the Title 11 programs, are actually impacting downstream impacts on revenue, downstream impacts on decision making, etc. And those are things that are really tough to model, right? Because every farmer is different. They're all driven by different behavioral factors. So you really need to start off at the producer level to even make statements, because you need to know what their preference sets are actually. So that's one big thing that we have been developing recently, getting prepared for changes to the farm safety net as they're coming up in a new farm build cycle actually, and discussions around it. A recent example of things that had been really bubbling up quite a bit, not just in the Dakotas, but more broadly in Arkansas and California and other states, had been changes to prevent plant buy-up. It had been a big concern, right? RMA changed their rule book in a while back, basically said, well, prevent plant buy-up, we don't need this anymore because there are ad hoc payments coming in every year, so why should we why should we continue offering this option basically? And they took it out. And so obviously I'll ask a more broader question, right? What is the farm safety net for and what is crop insurance role? And historically, crop insurance was implemented to get around these ad hoc payment cycles actually. And that's what it's good at. And that's what the purpose of this program should be. And so taking out a crop insurance tool that is actually sound with an argument that for the ad hoc payments that didn't stand well with us. And we actually conducted economic analysis here again to look into the program, look into loss ratios across the US actually to also debunk some of the claims that have been made. Right? Prevent Plan is not a North Dakota or South Dakota issue. It's very much a widely used tool with loss ratios being particular in Arkansas and California much higher than they are actually in the Dakotas actually. So that's it, right? We provided economic analysis here again, requested from Congress as well as USDA to look into how the program operates, what had the decision-making points actually, and how these decision-making points implemented farmer decisions as well as overall program actuary soundness and so on. So this is again an example of impact that we highlighted at AFPC that we are proud of is, again, there had been a coalition of congressional members from both sides of the House, pretty bold basically, that reached out to USDA to say, hey, this has to come back, right? There's an actual value to it. There's no economic reason or no this reason to actually take it away. It's an important tool. And then it's been also widely used and widely engaged with industry partners actually that have been very outspoken about how those changes impact their producers across impacted states.
Right. And these discussions seem to go a lot better when they're informed by this type of analysis.
Yeah.
So that's great.
You have seen the announcements that came out days ago actually that USDA had been is going to provide after they had received, I think, 450 letters from different groups actually as input to the decision-making process. They're going to announce a decision on what they're going to do with Prevent Fire pretty soon.
That's a good place to call it good for this podcast. And Sandro and Shawn, we deeply appreciate you offering your time and your insight on these matters. And hopefully we'll have you back again on down the road. Thank you so much for joining us today.
Same here. Appreciate you all. Thank you.
Once more, Sandro Steinbach and Shawn Arita. They're from the Agricultural Risk Policy Center at North Dakota State University. Also, thanks to our regular panel members from Kansas State University, Jenny Ifft, and from Iowa State University, Mark Edelman. This reminder, check out the podcast out of K-State, Smoke and Mirrors, Ag Policy Unfiltered, hosted by Jenny. Simply search for that by name online, Ag Policy Unfiltered. Also, feel free to go back and listen to our previous Clearing the Air podcasts. Those are housed at flinchbaughcenter.com, along with a wealth of other worthwhile features. flinchbaughcenter.com. Thanks to you for tuning in here. We'll be back next month for another go-round on agriculture policy. Eric Atkinson here from Kansas State University. Good day. The 2026 Flinchbaugh Forum is coming up September the 3rd and the 4th, and we're inviting partners who want to help shape the future of food and agriculture. If your organization values practical policy conversations, industry leadership, and visibility with decision makers across the ag economy, this is the place to invest. Reach out today at www.flinchbaughcenter.com to explore sponsorship opportunities and join us in moving agricultural policy forward.